Hello, folks. Welcome to Masterclass. I'm David Russell, Global Head of Market Strategy at TradeStation. Today, I'm pleased to be joined with Brandon Wendell, one of our mentor traders. Today, Brandon is going to be presenting a class in the Masterclass series on Futures Plus. I'm going to show you a few disclosures quickly. So basically, this one is lesson 5 on wealth preservation, risk controls for derivatives trading, presented by Brandon Wendell. And you can just see options trading are not suitable for all investors. And you can look at the disclosures here. Oh, I see how they come. And Brandon is an independent mentor who works with TradeStation, but he is separate from TradeStation. If you have any questions, please share them in the chat. We'll be monitoring those. All right, very good. I think we've covered the introductions. Brendan, I'm looking forward to seeing this. I'm going to go ahead and stop sharing. You can take over. And thank you very much. Look forward to seeing your presentation.
Great. Thank you very much, David. Appreciate it. Looks like everything's good here, so we're good. Welcome everyone to another session. That's actually lesson 5, the Futures Plus Masterclass that we've got going on here. And of course, we're talking about the Futures series, futures spreads, and options on futures, or futures options, whatever you wish to call it. My name is Brandon Wendell, and I'm a trader and trading mentor. I am not affiliated with TradeStation. I don't work for them. I was invited by TradeStation to come in and talk a little bit about this particular topic because I've been working in that field for almost 30 years. So I've got a little bit of a background in it and want to share my experience and information with you guys. If you got questions, please let me know. You can type them in the chat. I am monitoring the chat. If it's something that I can't really answer because it's TradeStation specific, David might be able to help you, or will refer you to the trading desk, obviously, to go ahead and answer some of those questions. Also, if you have questions about what we go over today in the workshop or the webinar, if you have additional questions, usually you think of them after we log off. You're like, we should have asked that. We can go ahead and email TradeStation, and basically you can get them. Let's see, it's education@tradestation.com. So I'll go ahead and put that in. Let me see if I spelled it right. Yeah, education@tradestation.com. There you go. Nizar, that is a very interesting question. Is it safe and more profitable? Not necessarily. It depends on the algo and on the markets. Everything that you see, a lot of black boxes off topic. I don't want to spend too much time on that, but you see a lot of kind of black boxes and systems being sold, and they often will work back testing, but the market's dynamics change from time to time, and you need to adapt and change with them. So from personal experience, I was not hired, but I was asked to go visit a tech company back, it was a while ago, almost 15 years ago, maybe 20, was it San Leandro, near San Francisco, near Oakland. And I traded against the machine with other traders, and we beat the machine almost every time. So it depends. Okay. Anyway, even if you have an algo and you're trading with it, you still need to be monitoring it and monitoring your risk management. It all comes down to you. How much are you willing to lose or risk? So yes, I'll go ahead and show you the past recordings and where to get those as well. David already went through the disclosure, so I'm just going to go ahead and jump right into it. And what happened here? Oh, I was in the wrong spot. That's why. My slides. I'll jump into, it's the wrong one too. Bear with me a moment. I swear I was organized. So yes, I'll answer that question right now. Where can the other ones be found? If you go to tradestation.com, there we go. And under Learn, there is Masterclass. And I believe you'll find the recordings there. So if you go, there's the Watch Live and recent uploads. If you go back or down a little bit more, there it is. 4, 3, 2, and 1 will be there as well. So that's where you'd find the location of the previous recordings and where this one will be available as well. So there you go. I gave you the link as well. And there we go. Back to the presentation because I want to stay on topic and time. For those of you who don't know me, just a quick blurb about who I am. My name is Brandon Wendell. I'm a chartered market technician, which means I pretty much have a master's degree in technical analysis. I've been involved in the market since actually 96, 97. I started off as a retail broker, moved into back office operations where I did trading for the brokerage, what they call agency desk operator. Then I turned into a hedge fund trader. I traded for a private hedge fund. It was closed fund in San Diego, California. Did that for a while, got burnt out, and moved back into just trading for myself because it's much less stress. There's still stress, obviously, when you're dealing with your own funds. I've also been on CNBC, Bloomberg, Fox Business over and over again. I actually did a class on technical analysis for CNBC Asia, had all the anchors and the people behind the scenes, producers, everybody there teaching about the market. So I've done this quite a bit, and I'm hopefully going to lend some of my experience and education to you. So for today, we're going to talk more about trading futures spreads and futures options. Now, those two are completely separate. I want to make sure you understand that futures spreads, which we actually, again, did a lesson on previously. When you go back to the master class, you'll see, I think lesson 1 and lesson 2 deal with futures spreads. That is trading one futures contract against another. It has nothing to do with options. It's similar when you do an option spread, you buy an option and sell an option. But in futures spreads, you're buying a futures contract and selling a related contract. Could be the same commodity, could be something different. So we'll talk about how to deal with your risk and the money you need to be able to trade that particular spread or even an option. It's called margin. And we'll talk about span margin, portfolio margin, how you use the margin. Now, keep in mind when you're trading futures and options, your risk, your loss that you are exposed to could be greater than the amount of margin you put up to trade that. Okay, it could even be greater than your account size. Hopefully not, but we need to protect ourselves and put in protective stops and monitor positions and make sure that you are comfortable with what you are trading. So we'll talk a little bit more about how to calculate the margin before you enter into a position. Because before you trade anything, you should know what it's going to cost you, both in deposits, margin, and even fees or commissions. You should know what your potential gains are going to be, because securities don't go up or down forever, right? And you might have a limited time for those as well. With futures, we have contracts that need to be rolled. With options, we have expirations. And most importantly, you need to know what is your risk in that position, because that's the only thing within your control. You can't control whether you're going to win or lose. You can only control how much you're going to lose and hopefully protect yourself and keep it to a certain level. Again, things can happen, but there are also actions that we as traders can take to mitigate some of that risk, stop losses, the time that we hold positions, perhaps not holding over weekends or nights, whatever it may be. So if you want to trade futures options or futures spreads with TradeStation, basically you've got to do it with a futures account through FuturesPlus. It's a separate platform. There's no fee for the platform, although you may have to pay for transactions and regulatory fees when you trade through them. And you can actually access it through the mobile app. There is a FuturesPlus mobile app you can download as well. So the nice thing about trading futures options and spreads is that they're not subject to the normal rules that you have with stock or stock option trading, being the pattern day trading requirements. So you can day trade with less than $25,000 in your trading account in futures options and future spreads, and even futures. They fall into the 1256 contract scenario. And I'm not a tax professional, so make sure you consult with a tax professional to see how it affects you when it comes to those margins and your trading. You also don't necessarily have to worry about wash sale rules. The wash sale rules are a bit of a hindrance for day traders unless you can get around it, and there are ways of avoiding those legally, that is. But the wash sale basically means if you make a gain and then take a loss in the same security within 30 days of that gain, either before or after, so it's like a 60-day window around that gain, you cannot write off those losses against that gain. So you might make a $100 profit and then take a $50 loss. But if it's within that window, you would still have to pay the taxes on that $100 gain, even though you didn't realize it. Well, with futures and options, futures options and future spreads, that doesn't matter. You don't have to worry about that. We do what's called mark-to-market accounting, and everything is much simpler. Again, talk to a professional, tax professional or accountant to let you know more about all that information. So getting back into trading, we have what's called span margin, standard portfolio analysis of risk. So I guess the AN is the analysis. They kicked out the R for span, for the acronym there. So this was created in 1998. It's used in more than just the CME, more than just the United States. It's used all over the world. and it changes the margins required based on what's called value at risk. I'm not going to get into all the details. You can actually look it up on the CME Group website if you really want to see. But basically, what span margin does is it requires you to put down a deposit to cover some potential losses in the position. So if I wanted to trade the NASDAQ futures, either as the contract itself, as an intra-market spread, or I want to trade NASDAQ options, I could do that, but I have to put down a span margin deposit to cover potential losses. It actually, in a way, protects the brokerage because they're letting you trade, and if there are losses, they have to take it out of your account. If the span margin has been removed from your buying power from your account and earmarked, it can be deducted from that without them having to go to your account. But as I said, it is possible to lose more than that margin deposit. So you could get margin calls or maintenance calls. We'll talk more about that a little bit. But basically, it's a performance bond to be able to trade a particular security. That's all. And again, it's a margin requirement based on a one-day risk for the trader's account. And margin for options on futures, depending on where you're clearing through in your brokerage and a clearing company, it could earn interest on longer term holds. It's not going to be huge. Don't get too excited about it, but you can look it up again, it'd be in the paperwork that you signed for your account, or you could see in some of the account information. But basically, it groups securities together to see how much risk a trader would have in one day, and it sets up the deposit that you would need to put down to be able to trade it. Entering and exiting or adjusting positions, your margin might change. So you have to be careful, especially if you're doing a spread trade, because with a spread, remember, you're buying and selling a security at the same time, or two different securities. The margin might be different on the spread. And then if you decide to liquidate one leg of the spread, the margin will change because it's no longer a spread trade. It's a single leg directional trade. And the margins can change drastically. If we go out to, I'll go to TradeStation again, under pricing, where's it? Futures margin rates, you'll see the margins that are required for individual contracts. For instance, I mentioned the NASDAQ. Let's see where you are. There's the NASDAQ. I'll scroll back up so I can see the headers. There we are. You can see this is the NASDAQ NQ intraday initial margin, 33.78. The intraday maintenance margin, let's see, where did I put that? Is it? Nope, wrong one. Sorry. No, I have a tool on here and I forgot the keystrokes that I did. Oh, that's fine. So anyway, the initial margin is a little bit higher than maintenance margin. What that means is in order to open the position, you must put down the initial margin. However, as losses occur real time in the account, it'll draw from that initial margin. And as long as your equity in that position remains above the maintenance margin level, then you're fine. But if your equity, basically the security drops in value, you're losing in your position. If your equity in that position draws down, in this case, about $308 roughly, then you may get a margin call because you don't have enough margin to maintain that position. You'll notice overnight has more risk. And sometimes the overnight long may be different than short. It's all due to the risk of that security. Okay. So moving along, that's the individual securities for the directional trade. I'm going to go here real quick and I'll talk about this a little bit later, show you what it's all about, but let's give you a quick demonstration of the difference in the NASDAQ margins. Here we are, NASDAQ futures. And if I wanted to do a spread, basically, I'm looking at buying the September NASDAQ contract and selling the December NASDAQ contract. It'll pop up in a moment. The margin, as you'll see, is much, much less. The initial margin to get into that spread on the NASDAQ is only $365. That is for the position, even if you hold overnight. And the maintenance margin, you can see there's not as much of a difference between the two. So they don't want you to lose too much, obviously. And the risk is much lower. But it's only $365. However, if you wanted to hold overnight just a single contract in the NASDAQ, it's typically $33,000. So what does that tell you? If the margin is that much lower, there's that much less risk in trading futures spreads versus trading the individual contracts. However, the rewards are also smaller. No matter what, when you're trading, if you want to get greater rewards, you're going to have to take greater risk. They go hand in hand. So we need to control that risk. So again, if you get into a single leg because you liquidate, let's say we sold one of the contracts that we bought on the NASDAQ. Now I'm still short one contract. I have to have that initial margin, or sorry, maintenance margin available. So you need to account for that when you're adjusting positions, or you have to exit the position completely if you do not have enough capital to meet the margin requirements. So this was another example that I did, and it was crude oil, March, May bull spread. And that was $1,150. We'll call it $1,151 for the initial risk margin. But if you decide to exit one of the legs, let's say we bought back the short May contract, now we are simply long the March contract of crude oil, you would need to have the maintenance margin available in your account. And if you didn't have that much available, you would have to liquidate your position immediately. And you might get a margin call. Actually, you will. So you'll notice I use this tool called the span margin calculator. You notice on TradeStation's website, they go back there, they have the margin rates for futures, but these are only single leg transactions. If we would go to energy, I just mentioned crude oil, there is the margin for crude oil, both intraday and overnight. Okay. However, we don't have the spreads. So to get the spreads, you use the CME website. Obviously, if you're trading CME products, if you're trading ICE products, like some of the softs, lumber or canola or coffee, you have to use their website and find the information there. I don't know if they have as good of a tool or not, but I don't usually trade those contracts as much. But this is a really neat tool that you can actually see what margin you need to enter a spread or trading options on futures. You'll see that as well. So first, you have to create a free profile in order to get access to this. You go to the CME Group website, and I believe, yeah, right here, you see the little silhouette of a person. You would click on that, and I'm already logged in, obviously. But if you're not logged in, you would just simply create a free account. It's nice. It's all free. Obviously, they want to help you. So you create a free account there. I guess I had it already here. Click on that body. Once you got the account open, you go to CME Customer Center once you log in. And then, excuse me, actually, I think I skipped the step because you have to go to portfolio and risk first. So let me just make sure. Again, I'm already logged in. So let me close that page, go back to the home page. So here we are, CME Group. I'm logged in. I go to CME Customer Center. It opens an extra window, and you go to the home page first. So yes, you have to go right here to portfolio and risk, core margin calculator. Okay, I don't use the new one yet. I haven't checked it out. I just use the core margin calculator. Once you're here, then again, you go to margin calculator, futures and options. And clicking on that gets you to the page where I just was. You can see I've used it quite a bit. So again, you go to portfolio and risk. Once you get there, margin calculator, futures and options. And then to create a new portfolio, I don't know why I call them portfolios. Your portfolio would be all of your trades. This is individual trades that you were setting up. You click on or hover new portfolio and click enter. And you saw me do that. And what it does then, it opens up this page. You create whatever name you want for that particular position. It says portfolio again, but it's an actual trade that you're putting together, either a spread or an option trade. So you can name it what you want. I did that NASDAQ trade. I just named it NQ. If you wanted to be more specific, you can always change it later as well. Once you put in the name, tab over to firm ID and account ID. You have to put something in there. It has to be a number, but it can be any number you want. I usually just type in 1 and 1. Okay, it's a requirement. You don't have to put in any specific numbers. You just have to put something in. You don't have to do description if you don't want to. Then you click product type and you select futures and options. Okay, and then continue. Pretty simple. Then it takes you to this page, add trades. So under futures and options, if you're trading futures, you just stay there, defaults to that. If you're trading options on futures, that's where you would click option. If you know the name of the security, you can simply start typing it, or you can bring the drop-down menu. When you start typing it, it starts filling in selections for you. Or if you happen to know the security code, the clearing code, you could use that instead. You got to be a little careful because some securities have multiple codes. Oops, wrong one. You got to go to Customer Center, New Portfolio, Enter, and let's say I want to do yen spread. Again, you can put in any number you want. Description I don't usually use, and futures and options, continue. And as I said, I could type in Japanese, it starts filling it out. Be careful, you want to make sure you pick the right one, Japanese yen futures. Notice it didn't fill out anything else. I have to choose the correct code. They have J1 and JY. Okay, if you're not sure which security you want to trade in the code, back here on TradeStation's page, all the codes are listed, the symbol roots right there. And again, this is under the futures margin rates. So I can scroll to currencies. Oops, where are you? There it is, Japanese yen, US dollar. Oh, it's JY. That's the one I want to use. If I wanted to trade a micro, that's available as well. Let's see the Japanese yen. Maybe there's not a micro on that one. There's the mini J7. So again, I go back to Customer Center. I select the one I want to trade. If it's not, or you make an error, just click Clear All. So I could also look for, was it 7J? J7, sorry. Transpose those. J, and you see it drops down a menu, 7. Click on that. Should bring up the name, E-mini Japanese yen future. There we are. Then you choose which contract you wish to trade. So again, if I want to do an intramarket spread, September 2025, am I going long or short? Let's say we're doing a bear spread. I'm going to short that one. Now to get the next contract, if it's the same security intramarket spread, I just hit the plus sign. Now I'll choose, oops, I scroll down a little. There it is, December. And in that one, I'm going to go long. They obviously have to be opposite of each other because it's a spread. So I add to preview. And once I add it to the preview, I click Save and Margin. And should bring it up in a moment, the report. Unless I did something wrong. That's odd. It didn't bring it up. So if it doesn't bring up the report right away automatically, you can simply go to yen spread. And that's weird. It didn't do it. Either it's calculating or something's happened. That's weird. So you close that one. Yeah, it didn't do a report. But normally maybe it's not available for trading. I'm not sure. I picked a weird one. If I pick normal, let's go back here and edit. Firm count. Oh, edit. Clear all. I'll do the full size JY. And again, the September and short. Save that one. Then I'll edit the other JY and December long. Save. So let me make sure. Yep, they're both there. Correct. Let's see. Close. And for some reason, it's not running the report on that one. That's okay. I'll worry about it later. Again, normally it'll just bring up your report. You saw it on the NASDAQ right there. It'll bring up the report with the initial risk margin, maintenance margin that you need for that position. And on this page, you'll see right here, margin result as well. So for instance, I had gasoline October spread that I was trading. I can click on that one. Let's see, do I need to deselect that? I can just bring up the report. And you can see it's showing me the initial risk margin, and then I can obviously see the maintenance margin as well. So you can bring up the reports on any of the ones you've already selected or create new ones. So it's pretty simple. Again, as you type a name, it starts to appear. I did crude oil in this case. It brought up all securities for crude, and then I select the right one. Select the date that I wish to trade. If I'm long or short, and you can do multiple contracts, it's not a problem. You just type in the number you want to trade. And then the plus sign to add the next contract. Select the month, the direction. If you're shorting, it's a negative number. If you're long, it's just a positive number. And then once you're finished, add to preview, save and margin. Oops. So you click that save and margin, and it brings up this report with your initial risk margin and maintenance margin. Remember, the initial risk margin is what you need to enter the position. The maintenance is the minimum equity required to maintain that position. So that's it. Pretty simple. Now, if you're doing separate securities, let's go back and let's do a new position, enter. And before I do that, let me cancel. Take that. Make sure when you're doing a new position, you take the check marks off. If you have a check mark selected, it won't automatically pop up the report when you finish the position. And you can still get it by clicking on reports, but I like to see it right away because I'm doing a lookup. So again, I'm creating a new one. We'll call this crack spread. Again, whatever numbers you want for the firm and account ID, futures and options, continue. And let's say we're going to do crude oil. So I type in crude, and there it is, the NYMEX crude oil, or I could have just typed CL. And let's do September. I'll go long there. Now, I don't use the plus sign because I'm going to be trading it against, let's say, gasoline. So I click add to preview, and it clears this screen, but notice my trade preview still shows the crude contract there. So for the next contract, I'm just going to type in RB. Does it keep rerouting you to the homepage? It shouldn't if you have created a contract or an account. So here I did RB. I think I did the September contract, so I'll do the same here. September and -1. Again, don't hit the plus sign here because it's going to want to add the same type of contract. So I just click add to preview, and there they are. I could actually add as many contracts as I want because there are some more complicated spreads where you have multiple legs. But for now, that's finished. I'll click save and margin, and it should be bringing it up. It is. There it is. Initial risk margin, $3,300. Maintenance margin, $3,047. That's it. That's how you find your margins for future spreads, both inter-market and intra-market. And we'll actually use this tool for the options as well. So again, we just repeat the process. New portfolio, enter. Again, put in a name, firm ID, you just put 1 and 1. Futures and options for the type. However, now we have to click the option button to make sure we're doing options, not futures. You'll still put in the same root symbols for the actual futures contract. Okay, so again, you choose the underlying by either typing in the name of what you want to trade, select it, or the clearing code. And then you click or select your expiration for the contracts. They have them listed there for you. And you just choose. Once you choose your expiration, then you decide, is it a put or a call? Obviously, drop down menu there. It automatically fills out your period, underlying period code. You have to select, you just verify it, make sure it's the right code. That's all. So April 2025 is what I had selected. Then you do the strike price, and you can use the drop-down menu or type it in. And of course, are you buying or selling that contract? If you are doing a spread, once you've selected the first leg, click the plus sign, and you can add in the second leg. That's it. It's pretty simple. And then it pops up. You just do the same process for the second leg or any other spreads. So there I did a call, 195, selling that, and I'm not sure what strike I was doing there for the long. And when you're finished, add to preview. When you're ready, save and margin. And this was 195 and 200. So I sold the 195, bought the 200. It's either a bull call spread or a bear call spread, depending on where the price was. And there's the initial margin. So again, if I go back, Customer Center, I'll just demonstrate it again, a new one. And let's see, I'm actually going to go to, there it is. Oh, my alerts went off. My Swissy contract, where are we there? That might have gone off a while ago. Nope, it's there right now. This was an area I was looking at for a possible trade opportunity, and we collapsed right into it. Whoops, went too far. Actually, let me increase this. There we go. And it's not going to be a good entry for me, I believe, because there's too much bearish momentum. But I was looking to possibly buy at an area of demand where we had lots of buying pressure. So I'll simulate that position. I would not do this right now, as I said. It's on a 60-minute time frame. Let me change and check the 4-hour trend. Oh, yeah, that's not going to bounce right now. So back to that 60, and we're right about 125.71. So where's the Swissy? Here it is, CHU. And I'm looking at the September contracts. I don't need all of them. Thank you. There we are. And you can see my strikes in the center. We got 125,500, 126. And below that, we just have 125 even. So it's 125,715. I'll choose the 125,500. If I'm looking for buying a call, I could click on that. And basically, it shows me the price. I know my strike. But before I get in, I want to know, what margin am I going to need for this? If, let's say, we're doing something different. Let's say we're doing a bull put spread. I'll do it a credit spread, bull put spread. I usually wait on this. I manually enter, and I wouldn't enter this one in particular because, as I said, the momentum's too strong right now. It doesn't look like that's going to hold well. So I would normally do more analysis and not just place the order with the alert. You could, as you saw, I had the alert pop up, and it usually sends me a message as well, email. But again, let's say we're doing a bull put credit spread. So I'm going to sell the 125,500 and then buy a deeper put out of the money. Let's say we do the 124,500. So I need to know, what margin am I going to need for this? So we'll call this Swissy bull put. Again, the account and firm IDs, 1 and 1, futures and options, and continue. Excuse me, I'm battling allergies a little bit here. So again, I'm on future. I go to option and type in Swiss. Should show me the Swiss francs. No. Let's try CHF. There it is. CHF USD. Okay, so it goes by that code or that name. And the code, you'll notice it's CHU. And I actually know that because right here you see CHU. Hang on a second. Let me see if I have that open. It's weird. Oh, there we go. Yeah, all right. Thank you. There we go. Okay. So that's what I wanted to do, zoom in. Now you can see right here on the chart, it's showing me CHU. Now, the way I found that is when you go to, let's say I want to do a new tab here, I can look up CME. Oh, no, that's not where it is. My apologies. Move the tab and I'll go back to CHU. There is a lookup, I believe, under widgets. Or no, there it is, Explore. CME option. And I forget where it is now. That's not it. There's a way to look up the symbols. I apologize. I'll have to ask Jesus. He's the expert on this. And it's in the videos as well for how to look them up. But CHU is the symbol that you need to use for the Swissy. So again, see it right here. When I typed in CHF USD for the Swiss, it showed CHU as well. The other contracts, I didn't show it now, but let me go back. Clear all. Again, if I do CHF USD, you'll notice 1SF, 3, 4, CHU. Oh, I know another way you can find it right here. If I go back to the futures and options, sorry, not futures and options, the CME homepage, do the little search button there and type in contract directory. That's another easy way to find the symbols. And then you may want to just save this under favorites, the contract directory and calendar tool. So right there, I go to FX. And now as I scroll down, CHU, there it is, Swissy, CHF USD. The loonie is CAU. The euro, EUU. Now, what are those other symbols? So you click on it, and it shows you this calendar, and you'll notice 3 SFN, 4 SFN, 1 SFQ. Basically, that's the third week, fourth week, and end is July. So there are weekly options available on these securities. And of course, if you click on it, it tells you the information of what it is. So this is the option, Swiss weekly Friday options, week 3 for July. It expires 10 a.m. on the 18th. It's a European style option, deliverable. Get all that information here and how it works. If you want to know what it's based on, click on future. And the underlying security is the 6SU25. That is the September futures contract. And it shows you when that expires. And again, all the information there. So that's the way you get the information for the symbols. I was looking at the monthly, and that was CHU. And actually, I stand correct. I want to correct myself here because I looked at September to give me more time. I could do the shorter one, but I was doing September. So I would actually go to that month. And we have CHU U5. U is September 2025. V, that'd be the October contract. So again, I just click on the right one. The letters for the month is the same as it is for futures. And option, there it is. Monthly options expires September 5th at 10 a.m. And it's been available to trade since 2023. It's European style, so don't have to worry about early exercise in that one. That's good to know. And it's based on the underlying September contract, which expires on the 15th. Great. So how much am I going to need to trade that? Again, I go back, wrong page, customer center. I got the CHU, the right symbol. Period code, I am trading the September, so I select the right month. We're doing a bull put spread and verify the period code is correct. Strike price. Oops. Scroll down to 125.5. There it is. 1.255. And I'm doing the bull put spread, so I'm shorting that one. Next, again, select September, put, make sure it's the right month, and select the strike price. I decided I was going to do the 124.5, and it's showing 124, but should be able to type it in. Oops, there it is. Because it didn't show it, I just typed it in, 124.5. On that one, I'm going long, and that's it. That's my bull put spread. Selling the higher strike, buying the lower strike, add to preview, save in margin, and it says risk initial margin 666, total maintenance margin. So I go with the higher number. The total initial margin is showing $1,141. That's most likely the one that's going to be needed. I make sure that I have well above that in my account, obviously, but I at least have that much available to commit to that particular position. Now, keep in mind, when I go back to the position here, if I put in that bull put spread, it looks like I have a position in already. Oh, I didn't realize I already had that. So there it is, my bull put spread, 120. Where's the 125 showing? Oh, it's 126 that I did. That's why. So we'll do this one, 125.5. And I'm in simulated mode. So right now I can't do the entire position all at once. However, if I were in live, it'd be a little bit easier to do this, because what I would do then is maybe create a custom spread. We go to 125.5, click. Oh, I did the wrong one. 125.5, short. I could change it later if I needed to. And long, there's my spread. I can open up order ticket, doing the spread. Again, in simulated, I usually just leg in individually, because there's also, where are you here? Widgets, options, strategy creation. It does not work in simulation, unfortunately, but it does work live. So that's where I would normally build my positions. So in this case, again, option, CHU, September 1.255, put. You just click on this to change it from call to put, and I'm selling that one. Next leg, CHU, it automatically fills that out, and I go to the correct contract, 124.5, put, buy, right there. And if I were, again, in live mode, I could go ahead and create an order ticket. However, unfortunately, in simulated, all you could do is watch, and I added to my watch list automatically there. So here it is, and there's the current pricing information for it. Doesn't open up, does it? Nope. So again, the main thing is to remember that margin is what I need to open that position. It is not my risk, though. It's not how much I stand to lose, because I'm short a contract. Again, I need to figure out how much is my risk, and when am I going to call it quits? Where might I want to get out? Looks like it was actually a decent position. Remember, I don't trade support and resistance. I'm a little bit different in the way I trade based on my history with trading as an agency desk operator and working with market makers. I use what's called supply and demand. And that's something I teach in my mentoring and everything. But basically, I looked back and I identified a pattern that to me demonstrates where the big institutions are likely accumulating a position, or they might be selling. I'll look for what's called supply. Supply and demand is basic economics. So this was an area of demand. You see that imbalance where there was lots of buying pressure. And in order to get those orders filled, the buyers had to aggressively raise their prices because there was limited sellers. And eventually everybody tried jumping in. This is what we call a novice candle. And that's why I pulled back to shake them out. It is true. The professionals do try to shake out the novices when they see them. And they actually see them on the charts. It's pretty easy if you know what you're looking for. So anyway, I identified this demand. However, I mentioned we're not going to get a huge bounce out of this. You see the reaction here. As we were approaching that area, as mentioned, we had lots of selling pressure, not much buying, but notice the candles. Actually, let me take off, get rid of the crosshair. Come on. So let me get rid of it. Why? There we go. So as we got closer and closer, you'll notice that bottom tail, the reason why we didn't close at the bottom is because that's buying pressure that pushed off. Same thing here. So as we approach that demand zone, again, the origin had an imbalance where there wasn't much selling pressure and there was a lot of buying. And think about it. If you bought, or sorry, other way around, if you sold here, how were you feeling when that went up? Not too good, right? So why would you want to sell there again? People remember what happened to them in the past. Remember pain and pleasure. Remember where we did well and we want to repeat that, and we remember what hurt us emotionally or physically, we wish to avoid that. So people are going to want to avoid selling in that area because it didn't work out too well for them. Institutions, the way they trade is they have to do what's called working the order. Okay. So when I was working for the hedge fund, even we had to do this. And I've taught this to other money managers, believe it or not. I did some mentoring for, was it one of my students? He was managing 100 million and he was having difficulty getting orders filled. And you have to do what's called work the order, where if you get an order to buy a couple hundred contracts, you need to split that up so you don't appear so obvious. You don't want to point, or you don't want everybody seeing what you're doing. For instance, we take a look at the spreads here. Oh, wrong one, sorry. On keystroke. I was trying to do this. Zoom in. You'll see, where is it here? Yeah. This one's not too bad. It's very liquid. At the money, we have a lot of contracts available. That's the 126 call side and the 126 put side. There are hundreds of contracts, although right now only 13 on the bid. If you had to come in, let's say you had to buy a couple thousand contracts in this case, if you were to put in your order for the full 2,000 contracts, that's going to stand out. And people would see that and they would try to front run you, right? That's what algo trading is all about, trying to front run the large orders. So what they had to do is break up the orders into smaller pieces and feed them in at times and try to get as many filled in an average price area. However, when prices leave that area, they stop, either up or down. They stop buying or stop selling. However, they want to get the remainder filled. When did they do that? Once prices return to that area. So what I'm usually looking for is the leftover orders. That's what supply and demand is, basically. In the origin back here, I know it's outside, but this is risk management as well, understanding what's going on in the markets. That origin of imbalance, that's lots of buying pressure. There's a high probability, again, I don't know exactly or how many, but there's a high probability there were leftover orders that were not filled there. And I could visibly see there were aggressive buyers who pushed prices up and the sellers were not there. They backed away, requiring the buyers to push prices up. The first time back, and there's patterns that I follow, literally, there's 4 simple patterns. When we come back to that area, now there's a chance for them to fill their orders, depending on what the overall market's doing. Obviously, things do change, and you got to keep that in mind. Trends change, socioeconomic events change, but basically, they're trying to fill a lot of those orders that weren't filled earlier. The problem that I have with support and resistance is they teach you that you're supposed to buy or sell in an area where prices have bounced. Well, if I'm trading leftover orders, each time I come back, there's less leftovers. It's going to be weaker. So for instance, let's see, I need a ray. There it is. This area. It's not great. It's drawing mode. But right there, just take a moment to edit this. Actually, I should use a different color. There we go. All right. So this area, again, I forgot to take it off. Drawing mode. There we go. Now I'm gone. So right here, again, there was a bit of an imbalance. You notice we broke out to a new high. There's certain patterns and things I'm looking for. But right there was somewhat of an imbalance. It wasn't as good as before, but there's lots of buying pressure and limited selling pressure. When we come back and get close or even touch that area, it's removing some of the buying pressure, the leftover orders. So when we come back again, it's not going to be nearly as strong, and either prices will go deeper or through it. We came back near that area a bunch, and you can see we blasted right through it, no problem. Same thing if I go a little bit back. Better example, probably here. And again, imbalance, come back to the area, and we bounced. We overshot it because we had too much momentum, but it bounced. However, there's no more leftover orders, and we're able to go through that pretty easily. But again, what people are taught often is, okay, this, as you can see, actually the bottom of that takeoff area, that's support, right? Because prices turn in that area, turn in the area, turn in the area, turn in the area, turn in the area over and over again. The problem is there's not any leftover orders there. And the market changed and blasted right through it. Not even that. Back here, it overshot it quite a few times and may have run a bunch of stops. So I don't use support and resistance because, again, I want to trade with the professionals, not against them. So I use supply and demand. And again, there's specific things I'm looking for. And it makes my risk management much better. Let's put it that way. So again, if I'm looking at a bull put spread here, my risk, I need to know that when I get into the position. I know the margin now, what's required of me for my deposit. I forget what it was, $1,141. I need to maintain about 1,080. So if I take some losses, it's okay. There's a cushion, but I also need to make sure I have enough capital in my account to cover that position if it continues to lose, or more importantly, I need to put in a stop loss or at least an alert to let me know I might need to exit. And what would be my risk if it does blow through all those? On a bull put spread, your risk, let's see where I go here. Nope, wrong one. In this case, my risk is going to be the difference between the two strikes. Okay, and again, we're trading options on futures, so we're dealing with the point values of the underlying security when we look at this. The quote, where is it right now? I was doing the 125.5 and 124.5, and that's really weird, the bid ask that's showing right now. But let's say it's using 0.009. That's what it was showing for a moment there. So 0090, that was the quote. Let's say that's what I'm going to have to buy, or sorry, no, I'm sorry. This is a bull put spread. It's a credit spread. So let's say we're getting credit of, this is really weird. I'll do the 14 right now. There it is, negative 14. It's pretty good. 0.014, right? You have to multiply whatever you get on your quote, the bid or ask, by the point value of the underlying security. And if you don't know what that is, contract directory. Again, we got CHU, got the information on the underlying security, UOM quantity. That's basically the point value of the underlying. But to verify, I can go to the futures contract. And again, verify. There it is, 125,000. It shows you, show here? Oh, it doesn't show the tick values on this one. Obviously, I can go to the markets and look it up for the tick values as well. But basically, the point values are usually shown right here under UOM quantity. So if I go to a different security, say we do equities, and I want to do the Russell 2000, you can see the different symbols, R1, R2. Obviously, those are weeklies, 1, 2, 3, and 4th week. The next letter is actually the day of the week, because this has multiple contracts throughout the week. And if you don't see numbers, it's usually going to be numbers in the front or middle. The end is always the year, but the front or middle are typically going to be the monthly contracts. Once again, I can click on them to verify, and there it is. E-mini Russell 2000 options, RTOU 25, shows me the expiration and the underlying security. If I clicked on this, R2DU, not R2D2, but that's week 2. It shows you right there. And you can click on, this is actually hyperlinked to give you more information on the contract specs, I believe. Let's see what it brings up there. Yeah, let's go into the contract specs for that specific contract, which is good. So I get that information pretty easily. Anyway, what was I doing here? The point value, UOM quantity, 50. So whatever I get for a quote, and there it is. Back to my FuturesPlus. This may take a moment to load up. CME, family, click on R. And we saw the symbol was RTO. So I have to scroll down, unfortunately, to find it. No easy way to do it. That went way too far. It's real sensitive, unfortunately, but there we go. There's the R2s. That's the 2nd week. 3rd. Sorry, it takes a little while here. R4 should be almost there. R5. There we are. So let's see. RB, gasoline. We're almost there. Come on. Okay, so here's RT. We want RTO. We're at RTM, which is different security. There's RTO, but too fast. And I'm just looking for RTO only. There we go. Finally. Nope, that's RTQ. That's weird. Of course, I pick one I can't find, right? Well, once you find the right contract, I make this easier. Go to NQ or whatever I find first. Just have to be a little patient. Not one of my strong points, but there we go. NQ. And then I could, oh, that may be why. Maybe I need RTY. And then you choose the contract right there. So yeah, let's do that instead. I'll go again. Hopefully not forever. Go up from the S's. And by the way, are there any questions so far on all this? Obviously, this recording will be available. There we go. RTY. Perfect. There it was. RTY. You got to do the symbol, root symbol here first. I forgot. And then there's RTO. I select and it will load up. There we go. And there's my September contracts. That's pretty fast. But again, the quote that I'm getting here, let me fix this. the quote that I'm seeing here, that's not actually what you pay, $86.50. I got to multiply that by $50 to get the actual price. So again, on the Swissy, 0.014, that's my credit I receive, times 125,000. Basically, I collect $1,750 credit for that particular spread. What's the width of the spread? I'm doing 1.255 minus 1.245. Do two zeros? No. And that's 0.01 times the point value again. Is that right? No. Yeah, that might not have the right quote for the price. But basically, my maximum risk would be the difference between the two strikes times the point value minus the credit I receive. Because if we go all the way down to the one that I bought, I could exercise the one that I bought while the one that I sold is assigned. So that would be my maximum risk. And again, I just don't have the right quote. That's not a big deal. But once I get, again, if I'm live, I'd have the better data and whatnot. But you need to know what is at risk when you're trading. And of course, an additional resource for you on options specifically, if I go back to TradeStation, under Learn, Options Education Center. And right here, a bunch of different strategies you can scroll through to find bull put spread. Nope, that's bull call. There it is, bull put spread. Click on that. And there's an article and video and even workspaces for TradeStation, not for FuturesPlus, but for TradeStation. And all these strategies, for the most part, will transfer into trading options on futures very similarly the way on options on equities work. So very similar there. And there's plenty of resources and education for you there. Again, I apologize. I can only show certain things on FuturesPlus right now because, again, I'm in a simulated mode, not live. I'm not going to do a live trade unless I do the correct analysis on it. You can also, I forgot to mention, on TradeStation itself, obviously chart futures. But in addition, when you're doing your risk management and figuring things out, should have done this earlier, go to OptionStation Pro. And I'm going to wrap this up now. So again, if you have any questions, type them in. And I'm going to wrap up in just a minute here. As soon as I just show you, you can't trade on OptionStation Pro for futures options, but you can do the analysis for all the positions as well. So we go to, there it is, options. And I think it was under SFU25. Is that right? Let's try at SF. Nope. You have to look up the symbol. Let me do it easier. I'll just do RTYU25 right now. Maybe it worked if I typed it in. Yeah, it did. SFU25. There we are. That's Swissy. I just didn't see it right away. So right here, I see these different securities. Again, CHU U25. That's the September contract. It also shows me the point value right there in the parentheses, which is nice. So again, if I want to do that bull put spread, I hold down the control key. Oh, not that. There we go. And take that back. I wanted to do the 125.5 sell and 124.5. And it tells you can't place orders here. You actually have to place the orders on, this one's showing delay, but you have to place the orders on FuturesPlus. So there we go. If I got the natural spread of 0.38. So once again, to know how much, I have that open. Calculator, 0.0038 times the point value, $475 credit. That's what I'd receive. And it shows me max profit, 475, max loss, again, the difference between the spreads minus the premium. And we're taking the spread size multiplied by the point value. So you do your analysis here to see what your risk is, but to analyze and figure out what kind of margin you need, you have to use those tools I just showed you on the CME website. So there you go. But yeah, you can do lots of analysis on these options on futures right there in TradeStation OptionStation Pro. But to place the order, you just simply go back to FuturesPlus. So that's what I got for you guys today. I'll be back for lesson 6 shortly when that's ready. You have to look at the schedule. Again, you find it on TradeStation.com. Look at the events that are coming up. If you have any questions, go ahead and type them in. If I didn't get to answer your questions, again, you can go ahead and email education@tradestation.com. So I want to thank everybody for having me here. Thank you, David. Appreciate it. I'll turn the floor back over to you.
Thank you, Brandon. I don't see any more questions coming through. I want to thank everyone for joining us and hope everyone has a great day. Thank you, Brandon.